You've heard me say you've got to buy the right stock in the right market at the right spot on the chart. But how do you actually decide what the right stock is? In this video, we're going to go through all of the things that I look at when I'm looking at a stock. Stay tuned. Here we go. On your screen, we've got what I believe is a super stock. And this is a super stock. If you want to go back and look at it from 2019, the stock was at $34 and now it's at $625. So those are the kind of stocks that we want to be in. We want to be in super stocks. And super stocks are great because they trend up. And when they trend up, if we're positioned right, not only do we get income through the cash flow machine that we do, but we also are on the right side of the trend, and so we get capital gains at the same time. So, we want our account value to be moving up if we can choose to have that happen. And over time in a super stock, that happens. What makes a super stock? Well, you know what a super stock is, okay? It's stocks like Apple and Google and Microsoft and Visa, and going back, it's Starbucks and Ford and GM and Piggly Wiggly, and you can go way back in time and you can find out what these super stocks are. Medtronic is another one. These are the stocks that you want to own, and these are the ones that don't just go up double in a couple of years, but they go up 10 times or 20 times or 50 times in the course of 10 years. And if you can hang in there, and that's why we always talk about getting income, so it gives you the opportunity to hang in there. If you can hang in there, you're making gigantic returns on your account. And if you could just hang in there and get income, you're making gigantic returns on your account. If you get both, great. I want you to own super stocks. This is not buying penny stocks. A lot of people are like, well, I'm going to buy a cheap stock because I can get a lot of shares. That's a dumb thing to do. That's like going to Kmart or Walmart now and saying, I'm going to buy the cheapest stuff they have and expecting it to last for a long time. You're just not going to, you get what you pay for in the stock market. And while there are buying opportunities, buying penny stocks and cheap stocks just so you can load up on a bunch of shares is usually not the way to do it. And you can look at the crypto market and you can say, well, Bitcoin is 40-something thousand dollars a coin, but Shiba Inu is 0.00000678 per coin. So I could buy, 2 million of those, with 10 grand. And thinking you're going to double your money. You might have caught it right, but there's no fundamentals there. So you don't want to buy cheap stuff. So we want to start with big, fundamentally high capitalized companies, several billion dollars at a minimum that trade a lot of shares. Okay, so now let's start looking at how I analyze some of these things, because a lot of people like the way I analyze charts. Now, before you get into a stock, 80% of your analysis should be fundamental analysis. And then 20% should be technical. I'm not going to focus too much on the technical. I'm going to focus on the fundamental. And by the way, I use MarketSmith. That's what you're going to see here. And MarketSmith is great, but it is expensive. I highly recommend it. But there's other ways you can get this information. You can get it at finance.google.com. You can get it at finance.yahoo.com. You can get it on your trading program, probably like Thinkorswim or Schwab. They all have these fundamental data points. MarketSmith just happens to have some proprietary ones that I like, but you don't need them. But I'm going to analyze several of those in depth right now. So if you stick to the end, you're going to see all of the 11 points that I highlight, and we teach these obviously in a lot more depth in our programs. But let me start here. We just go to the left side of your screen. First of all, I just showed you the beauty of what this stock has done. And there have been times where it's pulled back. You can see that in 2022. That was a bear market year, and this stock didn't escape being crushed during that year, going from 340 down to almost $100. But over time, when you zoom out, this is a stock that you want to be in. I think you can agree with that, okay? And so let's look at it. Let's start with earnings, because earnings is really the most important driver of a company, especially earnings growth. So it's a coupling of making money. So to me, I like to buy profitable companies. I don't like to buy companies that are losing money. So they've got to be profitable. And are they growing their earnings? Well, looking at this, in 2021, they grew, they made $2.50, which was up from $1.45 the year earlier in 2020. Obviously, 2020 was a weird year. But the company added $1.05 in earnings. And then the next year, look at it, it almost doubled to $4.44 in 2022. And then in 2023, it went to $3.34. Okay, that's a little bit of an earnings decline, and then you can see that's what the stock was kind of anticipating, and that's probably why it went down in that bear market. But in 2023 and 2024, all the rage was AI and chips needed for AI, and NVIDIA is perfectly positioned for that. So you see 2023 moving to 2024, it went to $11. They're looking at $11.32 this year. That's a 239% increase, right? Pretty incredible. Well, stocks trade on earnings increases and earnings growth because that means they're profitable, and that means shareholders can take advantage of that. And so you look at this thing going from $3.34 in 2023 to $11.32 to $19. That's gigantic, even if it is a 69% increase. If you look at the 3-year growth rate from 444 in 22 to 19 in 25, we're talking about almost a 5x, at least a 4x, 4 times your earnings. That's incredible stuff. That's why the stock is performing so well. Okay, then I like to look at sales, right? So going down, you can see the quarterly increase in sales, and there's some red numbers for sure. But looking at the sales, you can see quarterly in January 22, it was 7.6 billion, 8.3 billion, 6.7 billion, 5.9 billion. If you add all that stuff up, that's a number. But then you can go to the next 4 numbers, right? In 2023, 6.1, 7.2 to 13. There's not a double-digit number in 2022 to 18.1. So obviously sales is increasing incredibly. You can see the triple digits here, and you can also see the triple-digit quarterly growth next to it. So you've got earnings growth and you've got sales growth, and they're not just a little bit, they're big growth. We want big growth in our sales. I have specific numbers that I like, but we don't need to get into the specific numbers. You can see that the numbers are great, and that's why NVIDIA is performing as well. Okay, the next number I look at is the earnings per share growth rate. This MarketSmith is a great, has a proprietary great formula, but they use something like the last 3 years and they weigh different things on it, but their earnings per share growth rate is 37. I like to look at that to 20 to 25% minimum. This is 37. That's awesome. The next thing I like to look at is the return on equity. The way I kind of define return on equity is how well is management handling your money as a shareholder. That's how I look at it. And in this one, it's 34%. My research shows that 17% is great, but then you have to kind of adjust, because if you've got more debt, you can get better return on equity. It's just how much are you paying for the debt. So there's a little bit of a fudge factor in there based on return equity to debt. So, but still, it's pretty good, 34%. There's a little debt in there, but that's not a huge amount of debt compared to some other companies. I look at beta, 2.03 beta. Now, beta just happens to mean a multiple of how much the market moves. So if the market moves up a multiple of 1, this one moves up a multiple of 2. So it moves twice as much as the market, which is great, because if the market's moving up, and if you could figure out those spots on the chart where the market is moving up, then you can take advantage of a high beta. All right, then I look at what is the industry? What is the sector it's in? Well, you can see up here it says it's in the electronic and semiconductor fabless production sector, which is number 16 out of 197 industry sectors, okay? The group, relative strength rating is 92. So it's in one of the top performing groups, 92 out of 100 basically. So it gets an A, right? And so I like that number as well. So that's how I look at the left side of this. It's earnings growth on a yearly basis, earnings growth on a quarterly basis, sales growth on a yearly basis, sales growth on a quarterly basis. Is it in the right industry? Well, AI, the right industry. Chips providing AI with the material they need to do AI. They're providing Tesla a huge amount of chips. They have their own AI. They are in the right industry. Are they in a cool product? Yeah, we just talked about that. It's a cool product. Good management? Well, I've seen lots of interviews with this guy, and he is really sharp. So as a company, fundamentally, do you like them? Yeah, I like them. I could see myself being married to this company for a long period of time. That's a big important thing. And although you can't really quantify that, I can just see myself wanting to be in this. And that's important, because how many people do you know that bought Amazon at $1 and still own it, right? and it's at $160 or whatever it is, right? There are very few people, because when you buy it at a post-split price of $1 and it goes to $3, you're like, woo, I tripled my money, I'm a genius. But then you missed out on all of the other gains that you would have had, because it has fluctuations and it's hard to stay in. So you've got to really want to be in this company. And that there's one thing I've learned in the last several years is that you don't quit, especially if you buy a decent company, right? If you buy a junky, pot stock, or if you buy a junky company with lousy management, or if you buy a penny stock because it's cheap, well, you can't really be married. You can't hang in there. It doesn't have the institutional support. That's why I like big cap companies like NVIDIA, Apple, Google, Microsoft, PayPal, whatever, right? Big companies that have lots of institutional support. Yeah, they're not always there to support it, as you can see in 2022, but they are there to help it recover because they've got a lot of money invested. And I want to be on that side. I want to be on the side with the billions of dollars invested, not the ones that are being traded by Aunt Susie and they're, because they're cheap. So I hope that helps you get an idea of what I look for on the fundamental side before getting in a stock, because I use the 4 cornerstones in my system. It's the right stock in the right market, because not every market's right, at the right spot on the chart, and that's the technical side, that's on the right side of this thing. And then I squeeze the juice, and that means I get income from the stock while I wait for it to go up, because 80% of the time the stock is consolidating, and only 20% of the time does the stock actually sprint in a direction. And so I want to make sure that I know that, and while I wait, I want to collect that income. Hope that helps you understand the fundamental analysis of a stock, and see you on the next video. Take care.